All right, let's talk Valens Semiconductor, ticker VLN. They just dropped their Q3 numbers, and on the surface, man, it looked good, a solid beat. But the stock went down. So what gives? We're going to dig in and figure out exactly why Wall Street wasn't buying it.
So here's the game plan. We'll hit the big earnings numbers first, then peel back the layers on their revenue mix. That's key. We'll look at their guidance, the market's weird reaction, and then wrap it all up with our take on what's next for the stock. Let's jump in.
Okay, first up, the earnings snapshot. And like I said, on the surface, this looked like a pretty solid beat, checking all the boxes you'd want to see.
So check this out. They pulled in $17.3 million in revenue. The street was only looking for about $15.4 million. That's a beat of almost $2 million bucks. Not bad at all.
And it wasn't just the top line. On the bottom line, their adjusted numbers looked pretty good too. The loss was only 4 cents a share. Analysts were bracing for a 7-cent loss, so, they beat that by a solid 3 cents.
And get this isn't some flash in the pan. This is their 6th quarter in a row of growing revenue. That tells you they've got some real momentum, that they're executing consistently. So, you put it all together here, revenue, beat. EPS, beat. A smaller loss than expected, better gross margins. I mean, it's a clean sweep. By all accounts, the stock should have popped on this news. But it didn't. And that's because the real story is hiding just beneath these headline numbers. All right, let's dig into that mix, because this is where things get interesting. The whole solid beat story starts to fall apart a little bit when you look at where the money is coming from. And wow, look at this. The business has completely changed. Their cross-industry business, what they call CIB, is now a whopping 75% of their revenue. Meanwhile, automotive, that's shrunk all the way down to just 25%. This right here, this chart tells you everything you need to know. It's a tale of two companies inside one. You've got the CIB segment just rocketing up, growing over 40% year over year. But at the same exact time, the automotive business just fell off a cliff, down almost 38%. So all that great growth in one area is basically just papering over the massive cracks in the other. So, what's the deal? Well, management says the CIB strength is coming from a comeback in pro audio video and some new stuff in industrial machine vision. Cool. But the auto business is getting hammered by, manufacturing changes and tariffs. So the bottom line is, yeah, their pivot into new areas is working, but their old auto business is like a boat anchor, just dragging down the whole ship. Okay, so with that split in the business, what's the plan? Let's look at their guidance and where they're trying to take this thing for the future. All right, looking ahead, they're guiding for more growth in Q4, which would put them at about 20% growth for the whole year. That sounds good, right? But, and this is the big but, look at the gross margin. They're guiding it down to 58 to 60% from the 63% they just hit. That's a red flag for investors. It means pressure on profitability is coming. So where is this growth going to come from? Well, they're making it super clear they're all in on new markets. They're pushing hard into medical endoscopy. They just launched 3 new products there, and also industrial machine vision. That's their future. And to make it happen, they're shaking things up at the top. A new CEO, Yoram Salinger, is taking over, like right now. And the outgoing CEO, Gideon Bin-Zvi, really wanted to drive home why this medical play is so important. He's basically saying, look, operating rooms are full of electronic noise, and our chips are the only ones that can handle it without the video feed glitching out. That's a huge deal for surgeons, right? It's a killer feature, especially as everyone moves to these fancy disposable scopes. So, this all brings us back to the big mystery. We have a beat, we have a promising new strategy, so why on earth did the market sell the stock? This is the disconnect we really need to understand. The numbers looked good, but the price action was telling a completely different story. Yeah, on earnings day, the stock got smacked down 5.6%. The market basically looked at those headline beats and said, nope, we don't buy it. And this isn't just a one-day thing. Let's zoom out. Over the last 3 months, the whole semiconductor sector, the SOXX ETF, has been on a tear, up almost 20%. Valens, it's down 22%. I mean, that is a staggering divergence. It tells you investors have some serious, deep-seated worries here. So what are they worried about? Well, a few things. 1, for all the growth, they're still not profitable. They're losing money. 2, that guidance for lower margins, that's a big warning sign. 3, a new CEO always brings uncertainty. Can he actually pull this off? And 4, you've got the dying auto business and the fact that the stock is just getting crushed compared to its peers. It's just a tough story to get excited about right now.
Okay, let's put it all together. What's our take on this thing? Where do we go from here? Look, you can really argue this one both ways. The bulls will tell you, hey, the new businesses are on fire, they keep beating revenue, they have no debt, and a new CEO could light a fire under the stock. All true. But the bears will come right back and say, yeah, but they don't make any money, their old business is a boat anchor, the stock is a dog, and their profits are about to get squeezed. Also true. It's a classic tug of war.
So, after weighing all that, we're calling this one a market perform. The growth story in CIB and medical is legit, you can't deny it, but it's just getting canceled out by all the other problems. We think the stock is probably just going to tread water, moving with the overall market until they can actually show investors a believable plan to get to profitability.
And finally, here's our outrageous but plausible idea. Let's say you really like this Valens turnaround story, but you're nervous that the whole semi sector is a bit frothy. You could set up a pairs trade. You go long Valens stock, but you short the SOXX Semiconductor ETF at the same time. The idea is to bet on Valens outperforming the sector, whether the market goes up or down. You'd be watching for things like new medical contracts or signs that margins are getting better. The big risk, of course, is that Valens just fails to deliver and it ends up being the worst house on a bad block.
So that's our breakdown of Valens's quarter. Remember, as always, this is not financial advice. Please do your own homework and consult with a professional.